Hello, everyone, and welcome to our first lecture on accounting for bonds. Now, in India, we simply call bonds as debentures. In India, bonds are called debentures. Now, understand this that what are the general characteristics of bonds? First of all, there will be a fixed interest rate, right? Now, we generally call it coupon rate. So instead of calling it interest rate, we call it coupon rate. It's exactly same. Second, there will be a face value, which is called as par value. Par value generally means the amount that the company will repay on maturity. Unless there is a liquidating value. We'll discuss that separately because it's a lengthy lecture. But generally, par value is the amount which the company promises to repay at the end of the maturity. And it is also applicable for stocks, that is shares. For example, TCS, par value is just or face value is just 1 rupee. So in the event of liquidation, TCS is promising to pay the shareholders only 1 rupees against each share. You will tell sir market price is 4400. Yes, that is dependent on market factors. But par value is that amount that the company is promising. To repay. Because this is bonds, there will be a maturity because it's a loan. So this is the amount that the company is promising to repay on maturity. Remember, market price of a bond will be dependent on market forces. Similar to shares, bonds are also heavily traded in the stock markets. So market price of a bond will depend on market forces of demand, supply, interest rate, and all other factors. But par value is the amount that the company promises to repay to the lender at the on the maturity, and coupon rate is interest rate. Now always remember that coupon amount, what is coupon amount? Interest dollar amount that has to be repaid, that has to be paid at the end of a fixed period, 6 months, 1 year, whatever. So coupon amount, instead of calling it interest amount, we generally call it coupon amount. So coupon amount will always, and there is no exception, will always be calculated on par value, never market price of the bond. That gives you a ratio, current yield na. But the coupon amount, that the interest that the company will pay to the lender at the end of a fixed period, can be quarter, semi-annual, or annually, will always be calculated on par value. Now bonds are written something like this: 6% $1,000 par value bonds, and they can give the figures. Let's say they give the figures as, so let's say they provide the figures as $1 million. That is $10 lakh. Now tell me, what does this sentence means? This sentence means 6% is the coupon rate or rate of interest on the bond. 1,000 is the par value or face value that the company has agreed to repay to the lender, at the end of the tenure. And $10 lakh, because it's a dollar amount, means this is the total dollar amount of bonds outstanding. Now, how will I calculate? First of all, what is the number of bonds issued? Now, understand this. Total face value or total par value is 10 lakh or $1 million. Par value of each bond. $1,000. So how many bonds the company must have issued? That should be the total par value of bonds, that is $1 million or 10 lakh dollars, and divided by each. $1,000 bonds only company has issued. So this is the general format that they provide when they are providing information about bonds. That first of all, they will tell you in the bond line only, they will write the coupon rate, sorry, par value is written, and they can give dollar value directly. If they give number of value, multiply to arrive at total par value. Now, what is the coupon amount? As I said to you, coupon amount is always calculated on par value. So let's say this bond pays interest annually, once every year. So in that case, for one bond, 1,000 is the par value, and they will pay 6% interest per annum, $60. Always coupon amount will be calculated on par value. Nothing to do with the market rate of return, nothing to do with the market price of bond. So this is the basic information that is generally given in bonds, like how it is written, how it is denominated and all. Now, with coupon rate is also called as stated interest rate and some other names which is same. So another concept that is common is market rate of return. People also call this as YTM, that is yield to maturity. Market rate of return. What is market rate of return? Market rate of return simply means the return that similar instruments are giving in the market. See, coupon rate is in the hands of the company. Company can decide whatever interest rate they want to pay. But in the market, entire bond market, there is a rate of interest that is prevalent. That is market rate of return. That the similar instruments are yielding to investors. Now, always remember that market does not cares what you are offering. Market cares what the entire market is generally offering. So always investors will earn the market rate of return. It does not matter what your coupon rate is. We will get to it in few minutes only. It does not matter what your interest rate is. All the investors will always earn market rate of return. So first, what I said to you, coupon rate is used for calculating coupon amount, that is par value. For calculating issue price of the bond, this term you will keep on hearing, issue price. Issue price means the price at which the bond will be issued in the market for the first time. Remember, bond can be for a 20-year, 30-year period. So it will keep on changing depending on the market forces, but we cannot keep on calculating for all the time frames. So generally your examiner asks for issue price of the bond. So for calculating the issue price of the bond, always use market rate of return. Never ever use coupon rate of return. Never. So let's summarize what we have discussed till now very briefly. First of all, bond has a coupon rate generally. Zero coupon bond is also there, but we'll discuss. See, lot of concepts will keep on coming to your mind. Let's discuss it one by one. My life will also remain easy. So, coupon bonds generally have a coupon rate. Bonds generally also, that is your interest rate. Bonds generally also always have a par value, the amount that the borrower has promised to repay on maturity, face value in India for debentures. For calculating coupon amount, that is interest amount, we will always use par value and coupon rate. For calculating the issue price of the bond in the market, we will always use market rate of return. Now, let's do some basic examples and try to calculate market rate of return for instruments under different circumstances. So I hope you guys are clear till here, right? So let's look at example 1. ABC Limited issues 6% $1,000 par value bonds worth 10 lakh dollars, that is $1 million for a duration of 5 years. The bonds will pay interest annually. The market rate of return on similar instruments is 8%. So what is it? First of all, the coupon rate on the bond is 6%. Par value of each bond, $1,000. Total bonds par value that they are issuing. Total bonds par value, not number, is 10 lakh dollars. The bonds have been issued for a duration of 5 years. So they will pay interest in the first year, second year, third year, fourth year, fifth year. And in the last year, your principal will be paid back. Market rate of return on similar instruments is 8%. So similar instruments with similar credit rating. Now with bonds, you also have to get yourself rated. Mandatory generally for bond issuance. So there are global companies, there is S&P, there is Moody's. In India, I think there is CRISIL that gives ratings to debentures in India. These are global rating agencies. They even rate sovereign debt, debt of Indian government, debt of US government and all. So when we say market rate of return means similar rating. Let's say this bond is triple B minus. So other bond also which are triple B minus are giving 8%. So I will want same from this bond also. Na? So question is calculate the issue price of the bond. Now, always remember, always you can make a note also if you want to. Bond will always be issued at present value of all future cash flows discounted at market rate of return. PV means present value, huh? So always remember, for bond, we will always have how to calculate the market value or issue price of any bond. All future cash flows, discount it at market rate of return, you get the present value. That is the issue price of the bond. In bond, there are only two cash flows. First is coupon amount and second is principal repayment. Correct? No? In bond, there are only two cash flows in bond. One is coupon amount, one is principal repayment. There is no third cash flow in bond. So I have to discount these two cash flows at market rate of return. Now in the exam, they will give you either the table or they will give you the present value and annuity factor both. So let's say PV of $1 at 8% for 5 years. The way I had taught you in the last class, please compute it with me. 1 divided by 1.08 equals to first year, equals to second year, equals to third year, equals to fourth year, equals to fifth year. 0.68058. I'm taking 5 decimals. You can also take 3 or 4. So this is how you calculate PV. Now, how will I calculate annuity factor? As discussed in the time value of lesson chapter, if you guys remember, how do I calculate annuity factor? Simply press the grand total, this button on your calculator, 3.99271. This is the annuity factor. Now, let's calculate what is the coupon amount. So coupon amount is total coupon amount. Oh, they are asking calculate the issue price of the bond. So one bond they are asking. So on 1000 par value bond, 6% coupon will be paid. That is $60. Coupon amount is always calculated on par value. Na? Par value is $1,000 and coupon rate is 6%. Now this $60 you will pay at the end of first year, again at the end of second year, again at the end of third year, again at the end of fourth year, again at the end of fifth year. Principal, you will only pay $1,000 at the end of fifth year. So this will be paid only once. So where will I use annuity factor and where will I use discounting factor? Remember, annuity factor can only be used if cash flows are same, exactly same, and occur at same time intervals. So for interest or coupon, I will use annuity factor because they are occurring at the end of each year, same date and same time interval. So 60 into 3.99271. And for principal, which is repayable only once, I will use discounting factor. So present value of $1 at the end of 5 years at 8% is 0.68058. So what is the present value of $1,000? 239.56. 680.5. So what is the issue price of the bond? Present value of all future cash flows discounted at market rate of return. So we have discounted present value of interest and principal. That is the only two cash flows in bond. So issue price of the bond will be PV of principal plus PV of interest. So it will be $680.58 plus 239.56. Figure is 920.14. Bond will be issued at this price. Now see, par value is $1,000. That means company is promising to repay the holder of the bonds at the end of 5 years $1,000. But bond will be issued only at $920.14. Why? See, what is the interest coupon rate company is offering? 6%. What is the market rate of return that investors are earning in the market? 8%. So I don't care what the company is offering here. I also want 8% from this, na? That is how market economics work. So how do I earn 8%? Since par value is stated, coupon rate is stated, I cannot change coupon amount. It will remain $60 only. I cannot change principal amount. It will remain $1,000 only. If I buy it at discount, now see, if I get $60 on 1,000, it was 6%, but now I will get it on $920 only. So effectively in 5 years, I will earn 8%. So always remember, first conclusion, whenever coupon rate is less than market rate of return, bonds will be issued at a discount. The logic is very, very simple. That because investors always earn only market rate of return. So if your coupon rate is less than market rate of return, how do investors earn more? By buying it at a discount. So that will be it for this session, guys. We'll meet you again in next session and we'll discuss other topics relation to bonds only, other situations and all. So have a good day.